Episode 5, April 10th. Yesterday, PCE printed, and the market decided it was fine. SPY up 0.5%, QQQ up 2/3, AMZN somehow up 5.5% with no news whatsoever. Overnight, oil extended its gains after attacks cut Saudi production capacity, Trump threatened a fee on Iranian tankers through Hormuz, and futures are slightly red this morning. CPI drops before the open. Tom, Ray, morning.
Made a cup of tea and forgot it for 3 hours. Came back and drank it cold just to see who I am now. Tasted like a spreadsheet. Feels aligned with inflation. Same thing, worse experience. We all just agree to carry on.
Tom, spreadsheet tea is exactly why I only drink coffee that feels like a speculative tech stock. Bitter, expensive, and gives me heart palpitations. It's that classic inflation trap where you're paying more for a worse vibe, which is why the market was so relieved when PCE actually hit the target yesterday. But now everyone is back to holding their breath because CPI drops this morning, and nobody wants another lukewarm surprise.
Coffee that behaves like a bubble just means you're addicted to the story, not the drink. CPI is the same. Everyone wants a number they can believe in for about 6 hours.
6 hours is optimistic. Before the tape, 2 predictions to score. Mine from episode 4. If core PCE came in hot this morning, QQQ gives back more than half of yesterday's gains by the close. PCE printed sticky, roughly 3%, met expectations, not hot. QQQ closed up 68 basis points. Condition didn't trigger. Market went up. I was wrong. Also from episode 3, gold holds above 440 through this morning's CPI print. Gold touched 440.90 intraday yesterday and then closed at 437. Touched it and flinched. Also wrong. 2 misses. Now, on to yesterday. The market read PCE as permission to buy. AMZN led with a 5.5% move that had absolutely no headline behind it, and oil ripped again overnight on Saudi production damage. CPI hits before the open this morning. Did the market read Thursday right, or did it just talk itself into a comfortable story one day before the data that matters?
The market got one thing right. PCE wasn't a shock. The problem is, CPI isn't PCE. It's the first number that has to absorb what oil did last week. If it surprises to the upside, everything bought yesterday on the no new bad news thesis gets a remark. Amazon doesn't get to be up 5.5 on vibes alone if the 10-year moves 20 basis points.
And the oil story overnight makes that harder to dismiss. It's not just a headline anymore. Saudi production capacity is physically lower after those attacks. That doesn't reverse overnight. So we're walking into a CPI print with crude structurally higher than it was last week. And the market yesterday basically priced in none of that. The basement, Tom. Still smoldering. The living room just got very comfortable furniture.
Good furniture. The tape is up next. The tape. Thursday. SPY up 0.5%, QQQ up 68 basis points, and Amazon led the whole thing, up 5.5% with no news whatsoever. Tom, walk me through that.
It's positioning first, story second. Amazon didn't have news. The market had a need. You had PCE come in not worse, yields ease a touch, and suddenly every duration-heavy name, anything where the cash flows live way out in the future, gets mechanically re-rated higher. Amazon sits right in that pocket. Retail margins are fine, AWS is the actual asset, and the AI spend says, trust me, earnings later, which only works if rates stop climbing. So a 5.5% move with no headline is basically the market saying it's comfortable extending duration again, and Amazon's just the cleanest expression of that trade, which is great until the 10-year moves 15 or 20 basis points, and everyone remembers time has a cost.
You're spot on, Tom. But it's almost funny how Amazon has become this high-yield bunker for investors who are terrified of the rest of the market. Well, it's that inflation basement arc I keep talking about. We're all comfortable in the living room because the PCE didn't bark. But the floor is getting warm because the underlying prices aren't actually cooling off. If the 10-year yield starts climbing because it smells that smoke from downstairs, all that trust me AI spend is going to feel incredibly heavy when the cost of waiting for those earnings suddenly spikes.
And then we find out if the furniture was worth it. Also on the tape, oil. USO up almost 2% Thursday. Saudi attacks, Hormuz escalation. And energy stocks, XLE, down 1.25% on the same day. Oil goes up, energy companies go down. Tom.
It's the difference between the price of the thing and the businesses that have to live with the thing. USO just holds crude futures. Supply shock, price goes up, done. XLE is refiners and integrateds, and for refiners, crude is the input, so margins get squeezed. While the majors get some upstream benefit, but the market immediately goes, if this sticks, demand breaks and you don't get paid for it. So oil up on fear goes straight into the manageable inconvenience drawer, and the equities go, that drawer is starting to look expensive.
Oh man, the expensive drawer. I love that. But see, that's the nightmare for the Fed because this isn't demand pull inflation where we're all getting rich and driving more. Well, it's a supply-side tax that eats your grocery money without giving you a pay raise to cover it. And we're seeing that math hit the fan right now because this CPI print is the first one that actually captures the full weight of that oil surge. And it's like the market is finally opening that drawer Tom mentioned and realizing the bill is way higher than they budgeted for.
CPI, the invoice. One more, crypto on the tape. BTC up 1.2% Thursday. Coin down 3.5%. The asset going up, the exchange going down. Ray.
It's that classic disconnect where BTC is catching a genuine geopolitical bid as a hard asset because of the noise around Hormuz. Well, people want a lifeboat when the headlines get scary. Coin is just a spread business with regulatory baggage and operational costs that don't care if the token price is up 1.2%.
You can own the thing people panic into, or the booth charging them for the panic. One of those only works while everyone still trusts the exit.
Footnotes up next. Footnotes. Gold first. GLD touched 44,090 intraday Thursday. That was my call on episode 3. Gold holds above 440 through this morning's CPI. It touched it, then closed at 437.91. Tom, is that a flinch or just timing?
It's a tap on the glass and a not yet. You got the test of that 440 level into CPI, and the market immediately handed it back, which usually means the marginal buyer's already in. Conviction trades don't stall 90 cents from the headline number and then close underneath it.
Exactly. Because if that inflation basement was actually engulfed in flames, nobody is letting go of their gold at 440 just to bank a quick profit. That flinch tells you the big money is still more worried about a short-term liquidity squeeze than it is about the long-term fire the CPI numbers are supposedly signaling.
2 post-close items that landed after the tape and changed the picture this morning. Trump threatens a fee on Iranian tankers through the Strait of Hormuz. And separately, oil extended gains overnight because those attacks actually lowered Saudi production capacity. Not temporarily, physically. Ray.
This tanker fee threat is wild because it's basically a tax on global risk. And while the market is trying to price in ceasefire chatter, you can't ignore that this puts a massive squeeze on the actual flow through the strait. So, it turns out those Saudi attacks weren't just a temporary headline, but a physical hit to the actual plumbing of the oil market that reduces capacity for the long haul. When you put these together, we aren't just looking at a scare premium anymore. We're looking at a structural floor where the supply side of the equation has fundamentally shifted regardless of what the headlines say tomorrow.
Ceasefire optimism priced like a refund, tanker fees priced like a subscription.
2 contradictory signals running at the same time, and the market has to pick one. Ray, which one does it believe by Monday?
Well, the market loves a good story, but you can't trade hope for barrels once the refineries realize the physical pipes are actually broken. By Monday, the reality of that structural damage wins out, because while a ceasefire is a headline, a hole in the global supply plumbing is a tax that nobody can just talk their way out of.
The mechanic behind all of that, Nerd Corner, is up next. Nerd Corner. The story we touched in the tape but didn't fully explain. Oil up almost 2% Thursday, energy stocks down 1.25% on the same day. USO and XLE moving in opposite directions. Tom, what does the data actually say about this relationship?
So the part that matters isn't that they diverged, it's that they basically never do unless something's broken. In a normal cycle, XLE runs about 0.7, 0.8 beta to crude. It lags, but it goes with it. So when it flips negative, the market's not confused, it's making a call. It's saying, this is a supply shock, not demand, and those don't turn into sustained earnings because higher oil just chokes the consumer before volumes show up. And you can see it in the curve. Front month screaming higher, but further out, not really moving, which is the market quietly betting this price fixes itself by breaking something, which, historically, is not a great environment for equity multiples.
Tom, that's exactly it. See, the market is starting to realize that supply shock oil is the ultimate lose-lose for the consumer. Unlike when prices rise because everyone's out buying stuff and the economy is ripping, this is just a tax on being alive. And the really wild part is the Fed's position here. They're standing there with this massive interest rate sledgehammer, but you can't exactly drill a new oil well or fix a pipeline by making it more expensive to borrow money. So if this CPI print comes in hot this morning, it's the first one that really captures this surge. Then we'll see if that oil spike is officially turning into sticky inflation that the Fed can't touch without breaking the rest of us.
And that's why AMZN was up 5.5% the same day XLE was down 1.25%. Tom, same day, same data, opposite directions.
Yeah, it's the same trade said twice. XLE down and AMZN ripping is the market going, we believe the oil problem is real, so get me into businesses that don't care. AWS, ads, marketplace. Those cash flows don't flex with crude, they flex with compute demand and attention. So they become the anti-energy equity. And it's the same thing we were circling yesterday. AI as a rate bet, just wearing a different shirt. Duration good, inputs bad.
The sledgehammer and the Swiss watch. Calls are up next. Calls. Before the new ones. Scoring. I went 0 for 2 on my own predictions this week. Episode 4. If core PCE came in hot, QQQ gives back more than half of yesterday's gains by the close. PCE printed sticky, met expectations, was not hot. Condition never triggered, and the market went the other direction anyway. Wrong. Episode 3. Gold holds above 440 through this morning's CPI print. GLD touched 440.90 intraday Thursday, got within 90 cents, then closed at 437.91. That close counts, still wrong, 2 misses. The pending calls. Ray's episode 1 on core CPI at 0.4, Tom's episode 2 on NVDA down 8 to 10%, Tom's episode 4 on NVDA sub 165, Ray's episode 2 on the 10-year above 450, Ray's episode 4 on 445, my episode 2 call on gold catching oil by Friday close. Ray's episode 3 on European equities outperforming S&P by 1 point. All of those depend on what CPI says this morning. Audience will know before we do. New calls. Tom, CPI prints this morning. You're on record with NVDA twice. What's the specific call today?
All right, if CPI comes in hot, actually hot, not Twitter hot, NVDA trades 168 by the close today. And it'll feel obvious in hindsight because everyone remembers it's a duration trade at the same time. If CPI is clean, like clearly cooling, it squeezes straight through 190 and doesn't look back this week. The uncomfortable one is we get a nothing print and it just sits 178 to 186 and wastes everyone's emotional energy for 6 hours. I'll anchor it. 168 downside today on a hot print, 192 by Friday on a cool one.
Ray, 10-year. You've got 2 pending calls already. New number. Where does it finish next week?
Oh man, you're really going to hold my feet to the fire on those previous calls, aren't you? Well, I might be a little early, but I'm not wrong about the pressure building up. Because the 10-year at 435 is essentially the market trying to convince itself that the Fed has a handle on things. If CPI comes in hot today, It signals that the inflation basement I keep talking about is genuinely smoldering. And once the market realizes the Fed can't just wish that away, those bids at 430 are going to vanish. So while I was aggressive at 450, I'm calling 442 for next Friday, because that's the level where the reality of structural inflation finally starts to outweigh the hope of a quick rate cut.
Yeah, the 10-year only behaves when everyone agrees on the story, and right now the story is doing a lot of emotional work. If CPI pokes that, it's not a grind higher. It just gaps to wherever the adults were already thinking.
My call, AMZN. Thursday's 5.5% move on no news. Tom explained it in the tape. Duration trade, market extending, AWS as the real asset. My call is that AMZN gives back at least 2% of Thursday's move by Friday close if CPI comes in above the Cleveland Fed nowcast. 440 headline, 260 core. AMZN was the cleanest expression of the duration trade, so it should be the first thing that reprices when the duration story breaks. Call it AMZN below 228 by Friday close on a hot print.
I love that call, because you're basically treating Amazon like a giant proxy for the 10-year yield, which it is. If that CPI print comes in hot, we're going to see that duration premium evaporate faster than my coffee on a Tuesday morning.
That's episode 5. CPI drops this morning. You'll know the answer before we do. Find us on Spotify, Apple, YouTube, 3clowns.co. Back Monday.